A few months ago, I worked with a client named Calvin, and Calvin was a smart guy. He had really good credit, plenty of money in the bank, and he already owned 2 rental properties. But the issue was he couldn't get another loan because his tax returns didn't show enough income. Does that sound familiar? In this video, I'm gonna walk you through DSCR loans, step by step, with no jargon, no fluff, just simple answers to questions you probably didn't even know that you had. And make sure you stick around till the end because I'm gonna show you how to know exactly when a DSCR loan makes sense and how to get one approved almost anywhere in the United States. So what is a DSCR loan? It's really just a fancy way of asking, does the property pay for itself? And DSCR stands for Debt Service Coverage Ratio. So let me break out the whiteboard here to show you an example of how to calculate this. If you have a property and the rent is $2,000 a month, we're gonna be comparing that rent to the mortgage payment. So if the mortgage payment is $1,500 a month, then what we do is divide the $1,500 into the $2,000. That gives us a 1.33 DSCR ratio, okay? That means that the rent of $2,000 a month more than covers the property taxes, insurance, mortgage principal, and interest of $1,500 a month. That's what we want. Here's another example for you is you have a property, let's say the rental income is $2,500 a month, okay? And the mortgage payment on it, or let's say it's the same, $2,500 a month. So this is gonna cancel out. This is equal. This is a 1 ratio. 2.5 thousand divided by 2.5 thousand equals 1. So that's your ratio of 1. So the important thing to realize with the DSCR is that it's based on the property's income. Notice at no point did we go into how much you make on your taxes, how much you get at your job or business or any of that. It's based solely on the property's income, not the borrower's personal income. So why do investors use these DSCR loans to buy property? Well, as we're discussing, there's no personal income required whatsoever. That means no tax returns, no W-2s, no 1099s. You don't have to deal with profit and loss statements. You don't have to show your business verifications or any of that at all. So that's a huge advantage. Another reason why people use DSCR loans is because there's perfection when it comes to the type of people that can use these. You can be a first-time investor, self-employed, side hustler, retiree. You may not have any job at all. That's fine. That works for these DSCR loans. These are really a one-size-fits-all for almost any investor as long as you have the criteria we'll talk about. Realize that these loans can only be used for investment properties. So you cannot use these to buy like a vacation property for your family or a primary home that you're gonna live in as your primary residence. They are not allowed at all for these DSCR loans. The flexibility of DSCR is a big reason why a lot of investors use these over and over again. They can work for both short-term rentals like Airbnb, VRBO. They can also work for long-term rentals where you've got somebody renting a property from you for a year or several years at a time, okay? There's a lot of flexibility of being able to pivot between these different types of rental incomes in order to get the loans approved. Now, the next thing I want to talk about is the comparison, okay? Comparing DSCR loans to other types of loans that are out there. So let's compare it. The main product is going to be the conventional loan that people use, right? So on this side, on the left side here, we're going to put conventional. So with conventional, you have to deal with W-2s, pay stubs, tax returns, okay? You have to deal with all this, paperwork, basically, all this extra paperwork, all right? So that's the conventional loan. And while there are good parts of conventional loans, all this extra paperwork, all this extra red tape is the reason why most investors, especially once they get to 2, 3, 4 properties and beyond, they just don't make sense anymore. So let's look over here at the DSCR loan and then we can compare. So with DSCR, you're talking about the property. So we got to have a good property. It needs to be livable. It can't have any health or safety issues. That's the main thing here. It can't have any problems that the appraiser is going to point out as to why someone couldn't live there. And if the appraiser does come up with something, that's going to have to be fixed or repaired before closing. Now with DSCR, you do need a bigger down payment. So you're talking about generally 20, 25% down. There are certain cases where you can get 15% down, but for most investors, 20 to 25% down. And lastly, you need solid credit for a DSCR loan. And we're talking about 640 or higher credit. The better credit you have, the better terms that you're going to get on the loan. But if you compare the two, you're really seeing that the conventional loan is focused on your personal circumstance, your personal income, really. And the DSCR loan is totally based on the property. Okay, so that's the big advantage of using a DSCR over a conventional loan. Now, in our next section here, I want to talk about what lenders actually look for when it comes to getting a DSCR loan. So as we're talking about the types of properties and the criteria, generally speaking, lenders want to see a minimum DSCR ratio of at least 1 or more. So that means that the rental income is equal to or exceeds the mortgage payment. That's the principal, interest, taxes, and insurance on the property. As long as it's 1 or more, you shouldn't have an issue getting a DSCR loan. What happens is there can be issues when it falls below 1. So for example, the mortgage is $2,000 a month, but the rental income is only $1,800 a month. Now it's below 1. There are options, but you generally have to put a bigger down payment, and there's some other workarounds there. So another thing that lenders look for on a DSCR loan is going to be that skin in the game, the down payment amount. It's generally going to be 20 to 25%. As long as the DSCR ratio is 1 or greater. It could be more than 25% though, if the DSCR ratio is under 1. Now, one cool fact on this is that most of the DSCR lenders do allow you to use gift funds for some of the down payment amount. So it can't be all gift funds, but if you're short just a little bit on getting to the finish line on your property and moving forward, we can strategize and discuss using gift funds for a portion of that can bridge that gap. But the lenders want to see 20 to 25% down. The more you have down, the better, because the lower the mortgage payment's going to be, which is going to make that DSCR ratio that much better. Now, the next thing to discuss on what lenders look for is the property type. So what types of properties can you buy or refinance using DSCR loans? Well, the main types are going to be your single family residences, which is going to be 1 to 4 unit properties and condos. So single family, duplex, triplex, quadplex, or a condominium property, just a single unit condo. Those are the most common that I see. However, I have done several DSCR loans on mixed use properties. And with these, we can go up to 9 units, okay? 9 units. As long as the mixed use property has at least 51% residential square footage, so it's primarily residential, then there are options to use a DSCR loan on these type of properties. Next thing to discuss that lenders look for is your credit score. So unfortunately, you can't get a DSCR loan with like a 550 or a 600 credit score like you can on certain government mortgage programs. With DSCR, the higher your credit is, the better, but the minimum that I've really seen approved is 640 plus. In certain cases, a lot of equity refinances, I've seen 620 credit scores get approved on DSCR. But again, you have to have compensating factors. So you really want to shoot for 640 or greater on the credit score. Cash reserves. This is a huge part of getting a DSCR loan that differs from a lot of other types of loan products, which is that you need cash reserves of the PITI. So PITI stands for principal, interest, tax, and insurance. So the lender's going to look at how much the tax, insurance, and mortgage is going to be on the property that you're purchasing or refinancing. And they're going to want to see that you as the borrower have anywhere between 2 and 6 months of that payment in reserve somewhere. Most of my clients use 401k for this, cash value life insurance policies, retirement plans, bank accounts, or investment accounts. And we can usually use business bank accounts as well to satisfy this requirement as long as you're 100% owner of the business. In many cases, for a cash out refi, we can also use the cash out that you're receiving to go towards these reserves. But lenders want to see this extra reserve because you're buying an investment property. You're relying on the tenant to pay the mortgage. What if the tenant doesn't pay you for 2 months? The lender wants to see that you will have the reserve. You will have the savings somewhere to pull from to be able to make good on that obligation to the mortgage lender. So these cash reserves are super important. A lot of people only look at the down payment and closing and they forget about the reserves and then have problems getting a DSCR loan. So make sure that you have these reserves in place or strategize with your loan officer on how you can work them into the deal. No job is not a problem with a DSCR loan. So that's one of the things that the lenders don't look at is they don't look at the employment. We actually leave the employment blank on the loan application. It's completely left blank. Now, there's a lot of common misunderstandings with these DSCR loans, as you would think, because they're just very rare and misunderstood by many. So let's go through some of these different myths and misconceptions and dispel them right now. Do I need to show income? Absolutely not. You don't have to show any income verification for a DSCR loan. No tax returns, no profit and loss statements, no pay stubs, anything like that. What if I have write-offs and I show a low gross income on my taxes? It doesn't matter what you show on your taxes. With a DSCR loan, we're not looking at any of that. So even if you had hundreds of thousands or millions of dollars in losses, it will not stop you from getting one of these loans. Can I use this for my own personal home? The answer to that is no. You can only use a DSCR loan for investment properties only. What if I live in one unit and I rent the other out, like in the course of a 2-unit or 3-unit property where you want to live in one unit and rent the others out? Unfortunately, on DSCR, this will not work. This is for business use only, and all of the DSCR loans that I've originated, the lender requires the borrower to sign a document stating that this loan is only for business purposes and that you and your family will not be using the property. Any property will not qualify. There's a big myth that you can pretty much get a DSCR loan on anything, and that's absolutely not the case. The rental income does matter. The property type matters. A lot of lenders won't touch certain types of properties and things. So you need to check with your lender to make sure that a property is going to qualify and that the rental income will qualify for the loan. So we can generally do this by just finding out what the rental income is on the property and then what the expenses are on the property and figure out if there's even an opportunity to do a DSCR loan based on those scenarios. Okay. And the last thing is there's a big myth that you don't need reserves. A lot of people forget about the reserves on a DSCR loan. However, as we're discussing, all DSCR loan lenders require reserves. And the most common I've seen is anywhere between 2 months on the low end to 6 months on the high end. The way you calculate that reserves is by taking the total mortgage payment multiplied by the amount of months that we're discussing here. So if the mortgage payment is $2,000 a month and you're required to have 6 months reserves, that's going to be $12,000 that you're required to show in addition to the down payment and closing costs. The next thing that I want to do in our video today is to go over a real example, a real story of a client that I worked with named Brian, who recently purchased a property using a DSCR loan. So Brian was an experienced investor and a business owner as well. He owned 4 properties before buying this one we're talking about, and he was scaling up. He's looking to get to 10 properties in the next couple years. So he found a property in Bristol, Connecticut, and it was a 3-unit property. The first challenge was that only 2 of the units were occupied, so it had 1 vacant unit. Some lenders don't allow vacancy, so we had to find one that did. And our buyer, Brian, had really complicated income taxes because he had several businesses that he was ramping up that showed large losses. And he also had multiple rental properties that he had been renovating and repairing that also showed some negative rental income as well. So we didn't want to do anything that would show his tax returns because we knew that that wouldn't allow his loan to get approved. So DSCR saved the deal because we didn't have to show any of his personal income at all. So no loss was seen whatsoever. And the way the numbers worked out was that Brian bought the property for $390,000. He put 20% down. The monthly mortgage payment with tax and insurance was $2,834 a month. And the rental income, as it stood, was $3,550 a month. So Brian was walking into this property with a significant cash flow and a positive DSCR ratio really from the beginning. So this is the exact type of scenario that we look for. This was a very successful transaction, and this loan just closed here in the last couple weeks. Now let's talk about what you need to discuss and what you need to think about to know if a DSCR loan is right for you. If you're buying rentals and you have 20 to 25% down, then that's a great indication that this might work for you. If the properties that you're looking to buy cash flow or the homes that you already own have a positive cash flow, meaning that the rental income is more than the expenses, then that's a good indication that a DSCR loan will work. If you want to scale quickly your portfolio without dealing with all the extra paperwork and W-2 forms, then this is a great option for you. But there's certain factors that will really take away the DSCR as an option for you as well. So let's talk about where DSCR is a no-no. If you're buying a primary home, this isn't going to work for you. It's only for investment properties. If you're trying to buy with down payment assistance or low money down, like 3, 5, 10% down, DSCR loans will not work for you. You need 20, 25% down or more. So you do need to have skin in the game here. If you're trying to buy a property that doesn't cash flow at all, so you have a home that the mortgage payment's going to be $3,000, the rental income's only $2,000, that's a big red flag. It probably won't work on a DSCR loan, at least with the minimal down payment. If you're able to put more money down, like 30, 40%, we might be able to do a negative cash flow scenario for DSCR. But generally, if you're looking to put that minimum down, the property does need to cash flow at a DSCR level of 1 or greater, as we discussed. And the last thing is, if you have no reserves and you're pinching pennies to get the money together, then DSCR probably isn't going to work, because all of these loan programs require reserves. And as we're discussing, they all require a pretty good down payment. If this sounds like the right move for you for your next investment, I would love to help you. I offer DSCR loans in 42 states, and I've built my business helping investors just like you. So if you're ready to get pre-qualified, click the link below or give me a call. And if you want a deeper breakdown, watch my other video on how to qualify for a rental property without W-2s. I'll see you there.